this government is anti-business. I mean, George Osborne and his SDLT on real estate is bonkers. He's possibly the worst, has taken two of the worst decisions in my lifetime in terms of how it directly impacts London. Real estate is about the risk of how much debt you have against that asset, and that will tell the investor their appetite for risk and how long they will live if markets collapse, because that part of the equation is the LTV, so the loan to value ratio, and the higher up you get, the more your risk. But it's great for returns on equity. If markets are going up, you can make huge amounts of money. But if markets are going down and you're 90% levered and it goes down 10%, you're bust. I wasn't the smartest knife in the drawer, but I've been lucky enough to always surround myself with super smart people, much smarter than me.
Welcome to the People, Property, Place podcast. It's great that you've joined us today. If you're new to the show, welcome. And if you're returning back, thank you so much for joining us today. I'm absolutely thrilled to be joined by Nick Leslau. Thank you for joining me on the show.
Thank you for inviting me.
Not at all.
I'm excited.
Great. Well, look.
I'm not a podcast junkie, so I don't do these very often.
Yeah, well, it makes it even more special that you're here today. So thank you. So, Nick, did real estate choose you, or did you choose real estate?
I definitely didn't choose real estate. I chose what I wanted to do was make money when I was a sort of student, and came from, my mother was an immigrant from Poland who sort of fled the war, fled after the war. And so I had no real connection to real estate. I just knew that I wanted to make money, and I didn't really care how I did it. So at school I was trading anything from pens to bicycle clips to, you name it, I would trade it. And so I had, my maternal grandfather had a couple of flats and rented them out. And that was my only real connection. But then I knew I had to get qualified at something, because in those days you kind of, you went to university, or you should try and go to university and get qualified. And I went to university to do French and German. Decided after a year that I really wasn't into Kant and Schiller and Goethe, and so I switched to real estate. So I switched to South Bank Poly, which is now London South Bank University, to do estate management, because I thought property people make a lot of money, don't they? So that's how I got into it, and it was a sandwich course, and I worked at what was then Hillier Park and now part of CBRE, and for a year. And I really didn't like property services. I wasn't ever going to be a good servant to other people, and decided I had to be on the other side of the fence. And that's really what happened. I joined this very small property company, knowing nothing about nothing, and just kind of learnt. And so that's a very long-winded answer to, I didn't choose property, it sort of chose me because it was there. I often wondered to myself, would I have been any good if I'd done something else? And, I'll never know the answer to that. But I think actually I was a decent salesperson. I was totally unacademic, useless with numbers, but I was quite good at persuading people to do things. And so I guess that's how it started. And then you get a bit of luck and you call markets right. And, then suddenly you go from being the enfant terrible that I was in real estate to being, what do they call me now? A veteran, which is awful, absolutely awful, because I don't feel like a veteran. Yeah.
So we'll come on to that kind of first kind of client side kind of move. But am I right in saying you went to private school, and is it there that you kind of felt like I want to make money here, because you weren't necessarily as moneyed, or you didn't come from a kind of a background as moneyed as maybe some of your contemporaries?
I definitely was born and raised on the wrong side of the tracks in Cricklewood, and my maternal grandfather had some money enough to be able to afford to send my brothers and I to private school. And it was at private school that this sort of intense feeling of insecurity was developed, where you suddenly realise that, you're getting stuff from the thrift shop and they've all got new Puma rugby boots or new Slazenger tennis rackets or cricket bats or whatever it was. And you don't, and you've got second-hand kind of, or hand-me-down uniforms, and they're all being picked up in Rolls Royces and BMWs or Mercedes or whatever it is, and you're going home on the 113 bus down the Finchley Road. And sort of that made me want to have what they had without much thought. I mean, this is kid stuff, it's like, I want what they have. But that created an intense desire on my part to want to live in a nice house somewhere in those days, I guess would have been Hampstead or St John's Wood, or so that's where it started. Yeah.
And you said you weren't particularly academic.
No, I wasn't.
Sporting rugby is a big, kind of passion.
No, sport was a big thing for me.
Yeah.
But no, and I suspect today I would have been diagnosed with ADHD or ADD. My parents had gone through a really awful traumatic divorce when I was started when I was 7 or 8 and lasted for a few years, and neither of them behaved with enormous dignity through that process, I'm sad to say. And I think that's when I sort of, I knew I wanted to do something different, and I wanted to be something different, and I couldn't do it academically. My older brother was very, very smart, went to St Paul's, and I was just, my learning skills either switched off or never switched on. And so I was 16 before the lights started coming on, sort of intellectually, let's put it like that, or academically. And I was at boarding school, I was at Mill Hill, and I remember we had lessons on Saturday mornings. I remember one maths lesson, and they were doing quadratic equations, if this is for O-levels or GCSEs as we call them now. And I remember kind of looking at the blackboard, and suddenly it was almost like a light came on. And I suddenly went, I understand this. And historically, as a kid, if I was doing fractions and you showed me how to do the fractions, I could do them like one after another after another. If you changed the order of the questions around, I couldn't do them. So I suspect I had some spatial
pattern recognition,
something problems. But I dug up some old reports from the Hall, which is the prep school in Hampstead, a very academic prep school in Hampstead. I think I was 6 or 5. And one of the reports says, Nick, or Nicky as I was called, continues to struggle with his pencil skills. Which I thought was very funny. I couldn't really do anything. I couldn't add up, and I couldn't really handle a pencil very well. And it was ironic because when I did the BSc Estate Management at South Bank, there's part of the course which is constructions technology, and you have to do some draftsmanship in there. And literally, I remember sitting at a draftsman's board with all the equipment that you use to draw a straight line, and other people's straight lines were beautiful and immaculate, and mine were like big blobs of heavy and then light, and then literally I couldn't do it. And to this day, my writing's shocking, and my maths is a little bit better. But I don't know whatever I had in there, kind of the light switched off at 16. But I was so far behind, I just didn't have the foundations, and I was playing catch up. And so to this day, I am literally confused by zeros. So I can, which is probably slightly worrying. I think probably the world, my investor support over the years would probably be shocked and are happy to be hearing this now that I'm not so active in business, that I struggle with the zeros. How many zeros is that? How many zeros should that be? And as I say, it's ironic dealing in millions, tens of millions, hundreds of millions and billions that I can't get my zeros right. But that's why you employ super smart people, because they know what the zeros mean.
So you joined Berford at 23 or so, and you became chief exec at 25.
Yes. So Berford was just a tiny property company that had started in 82 by a chap called Sam Rosen, who had come up with some ground rent investments very cleverly, and he'd borrowed £200,000 to do this deal, and then he needed some help, and I met him through a mutual friend, and I sort of joined him because I knew I wasn't going to be a professional services person, and we literally were doing the ground rents and trading individual ground rents, and then we developed into buying very long dated reversions, because the first ground rent portfolios were all short reversions, so you could do marriage value deals, and then we were buying super long 999 year leases on very low ground rents, £1, £3, £5, or 5 guineas even. In some cases, they were so old. Do you remember what guinea is?
I never dealt in guineas.
A guinea is £1 and a shilling, anyhow, and that's how what a guinea was, and that's how some of the leases were so old that's how the ground rents were formed. But then we bought tens of thousands of these, the entire Wimpy ground rent portfolio with Hearts of Oak Society. We bought lots and lots of these portfolios, and what we were doing is we were paying 4 times the rent, which today seems so ridiculously cheap. So if the ground rent was £5, we were paying £20, but we were then offering them to the lessee, the freehold, for 50 quid. In other words, so we're paying 20, so we're making a massive margin, or 70 quid. And you'd say, well, under statute, under the Leasehold Reform Act 1967, they could enfranchise and only pay 10 times. So why would they pay many times more? And the answer is because under the Act, they'd have to pay professional fees, their professional fees, our professional fees, surveyors' costs, valuation costs, etc. So a £100 purchase, or sorry, a £50 purchase could end up being £350. So we would then sell it to them for 20 times, and it would still be half the cost that they'd be paying. And then we had an interest-free deal. We had these old ladies sitting in a warehouse in Essex, and literally they had 10 pieces of paper. So if it was 10 installments, interest-free, and people would write checks for their 5, if say it was 200 quid, for 20 quid, and only when we received the last installment would we then transfer the freehold. And it was just a sort of money printing, good for the enfranchisee and good for the enfranchisor. So that's how we kind of started. And we thought we were pretty good at it, because I think in one portfolio, our biggest portfolio, we literally had a deferred completion. By the time we completed, we'd sold 20% of the portfolio and paid for the whole portfolio.
Wow.
And then Robbie and Vincent Cengiz came along. We thought we were really smart, buying for, and then selling. And we'd sold a lot of them. We should have kept it. They came along and said, we'll pay you, I think, 12 times. And we were young, didn't have any money. Sam was older than me, but didn't have any money. And so we sold and made a fortune, and relatively made a fortune. What we didn't realise was that the Cengiz and Tim Smalley, their FT, had worked out that they could go into the securitisation markets and get these valued at 40 times, because what they recognised that I didn't recognise was that the ground rent was a AAA credit, because if you don't pay the ground rent, you get the house back.
Yeah.
And of course, that was so obvious after they did it. And so I was like, ugh, I missed that trick.
Yeah, I've had 12x, but it could have been significantly more.
Yeah, I mean, it could have been 40 times. And so Cengiz, did the deal. They securitized it. They got 3 times their money back just by financing it. And then they kept the process going. And that portfolio forms, I think it's the core of Long Harbour today. I think it's the core of their portfolio. But it was an amazing way to start. And of course, as we were making lots of money out of that, we started investing in commercial. And that's when I kind of realised how little I know. But we got caught on the wave of a bull market. And so it sort of didn't matter that we were buying trashy real estate, because the market just bails you out. And we bought the Piccadilly Plaza Centre in Manchester, which was 1 million square feet. This is quite incredible.
And you were how old at this stage?
Oh, I was 20. Oh, we'd floated. Sorry, I've lost the chronology a bit. But so I joined in 22, and the company was worth 200,000. We floated in 86, and I became chief exec for 8 million. And then a year and a half later, Nigel Ray reversed a company called Charles Search into our business and paid us 50-some million pounds for the company. And then I stayed on. Nigel asked me to stay on and run the business, and then I kind of rolled in a bunch of stock and then got incentivized. And that's what we built into a £1 billion business over the next 10 years. He was chairman, I was chief exec.
But you were the youngest, by age, listed CEO, if I'm not mistaken.
Yeah, I think that's true. And I think to this day is true.
At
and
25?
Yeah. And I was actually at one stage another only chief exec of 2 public companies at the same time. It was admittedly only for 18 months, and I nearly killed me doing it. But it was, it's weird because, look, in those days, it could never happen today. And at 25, I suppose there could be a tech genius somewhere who could be a 25-year-old chief exec. But I don't really know why it happened and how it happened, but there was nowhere else to be chief exec. So I think my title was managing director, but, there is an expression I use a lot, which is never confuse a bull market with a genius. Okay. And we were in this bull market, all sorts of strange things were happening and values were going up and up and up. And I was in the right place at the right time. And we sold to Nigel, and then this is about 88, 89. I said to Nigel, we've got to liquidate everything. I said, this is mad. People were buying real estate investments and borrowing 110% of purchase price.
Yeah.
And I wasn't, I wasn't the smartest knife in the drawer, but I did recognize that this was bonkers. It's not possible to sustain that. And so I phoned Nigel up. I remember distinctly phoning him up one weekend and just saying, Nigel, this is bonkers. We have to liquidate, and quickly. And he said, I agree, let's do it. And then we literally just went to cash. We just sold everything, went to cash.
So this was after buying a few kind of commercial units?
Yeah, no. I mean, at that stage, we owned some pretty big stuff. We owned Henrietta House, which was now the CBRE headquarters. This is before it was redeveloped. We owned Piccadilly, but we owned a portfolio probably a few £100 million. And so we liquidated it very, very quickly, and went to cash, and then the market crashed.
So before we get onto that, we went from kind of 200 grand to an £8 million portfolio.
Bear in mind, I wasn't a partner when I joined. I was just a hired gun.
Yeah.
I bought equity as I went along. So I went to we were clearly making money. I clearly had a part to play in this. And I went to the guy who financed it and to Sam who started it. And I said, look, I want to buy 10% of this business based on a pretty conservative valuation. Then I wanted to buy another 10% of the business, which I paid. I borrowed money from them to do it. And that's how I got equity.
So that's how you built up your equity stake. So when it went to 8 million, then Nigel bought it for 50 million. That's where you were able to make some serious personal cash, right?
Correct.
First.
Yeah. So I think I was 26 or 7 when Nigel bought it. I think when we floated 25 or 26, something like that. And I had made, I think I walked away with 4 or 5 million quid, which is, it's 40 years ago now. And
it's equivalent to like 20 million quid now in today's money?
Probably more.
More?
I would say so. Yeah, I mean, look, whatever it is, it's a significant.
When
you're 1 minute you're a student and literally you can't pay off your credit card bills, and then you join a small property company, and then this whirlwind. And when I joined, my salary was, I think Sam offered me the same like Hillier Parker had offered me, which is like £3,000 a week. A month, a week, sorry.
Yeah.
A year, a week would have been all right. But I was much more excited by the fact that he said you can buy a new Golf GTI because you're going to be travelling up and down the country. I mean, that was way more exciting than my salary. I had no obligations. I had not, I had to pay some rent on a rental property. And so, so it was kind of, the money was almost it was too much to understand that much money when you've got nothing and you can't pay.
Yeah, and you've had thrift shop hand-me-downs, and you've been envious of people's new Slazenger jackets, and then suddenly you've come into 4 million quid or what have you.
But I'm lucky because I've never really, it wasn't like, let's go out and buy an amazing car or a helicopter, or I wasn't that person. But equally, I wasn't thrift. I wasn't going to be, I wasn't Mr. Thrifty. But we bought Maxie and I just had recently got married, and we bought a nice apartment in Fitzjohn's Avenue, which is sort of Hampstead. And, I don't know, we actually did move to Knightsbridge, but it was a short lease in Knightsbridge. And I just got on with it because I was now so into building this business called Berford. It was called then Berford Holdings, and I wasn't really interested. The money bit didn't really.
You just loved the game.
Yeah, and it wasn't really a game to me then, because it was just I'd found something I was good at, or I thought I was good at, and that's the first time in my life, because playing sport, you're kind of as good as your last match. So you might think you're great playing, number 7 in the back row, and then you win a game and you've scored 3 tries, and everyone thinks you're a genius. And the next match, you fluff your lines and lose badly. And so, sport was. I loved sport, and I did get a name in sport in my small little group for being pretty decent at it. But but making money and kind of doing it, and then there started being articles in the papers, about me or our business, and it was, we didn't have a PR person. I've never had a personal PR person. We've had corporate PR, because you have to, as a public company, it's a requirement. You have to have a financial PR. And then people started sort of writing things. And one of the most important bits of advice for anyone who I speak to, who's starting to get that corporate, excuse my French, bullshit written about them, is don't believe anything that you read about yourself. Because I've seen it so many times where people start to believe they can walk on water, because they appear in article after an article, and it blows hot air up them, and they start believing it, and they start acting irrationally, and it never ends well. It just never ends well. So I got distracted on that one, but it is quite an important thing. And so I was getting this approbation, third party sort of recognition, which was way more important for me than the money. It was like, oh, they're saying Nick Leslau can do something well. I didn't believe that I could do it well, because I do have a fundamental view that the minute that you do think you're any good at anything, you're probably dead in the water. You just cannot, you always have to have humility, and always have to recognize there are people much smarter than you, much cleverer, much more ambitious, and and that you are there, and you've got to recognize that there is a peer group that would blow you out the water at any time. So you need that humility, I think, which is probably why I'll never be a billionaire, because I think you have to be a billionaire, you have to be absolutely abjectly ruthless and have total self-belief. And I've never had total self-belief. Even today, in my twilight commercial real estate years, I still absolutely know I am terrified is an overstatement. I get very nervous on any deal we do. It doesn't matter how small or how large. I blow hot and cold. And I feel if I don't do that, I'm not going to be analysing it properly. The very, very few times in my life have I ever come across a deal where I've gone, that was just such a no-brainer. You've got to do it. Twice, in fact. So
89, you sold out your portfolio ahead of the 1991 crash.
It was really 89, 90, but yeah.
89, 90, ahead of that kind of crash. And then was it a case of let the dust settle and then start piling back in and riding the next wave?
No, yes, let the dust settle for quite a long time. And actually, it was funny because as part of the sale of Henrietta House, we had vacated it. We literally bought out all the leases. It was empty, and we'd sold it to a Dutch pension fund who were going to knock it down and rebuild it. Of course, they were kind of in this awful time with the crash happened post-exchange and pre-completion, and they were looking at rents that I think, but even back then they were forecasting, so we're now talking late 80s, we're talking 80 quid, 75 quid, 80 quid and 4% yields. I think it took them 30 years to get back to that level. But part of the deal was that I wanted to keep my office in Henrietta House. So I had a 1,000 square foot office where I had 2 or 3 of my colleagues in there. And the market had just bombed all around us in this empty building. I think then it was 80,000 square feet, literally us on our own. And Franco and I, this is Franco Sidoli, who he and I have had we're kind of like brothers, and he's the outstanding I was going to say don't tell him this because it'll go to his head, but of course this is a podcast. He's the outstanding investment agent of his generation. There's probably 2 or 3 of his caliber. And he and I have just been super, super close. And I think 98%, 99% of the deals I've done with Franco. But he and I were sitting in my office for a good 6 to 9 months. And there was a store, it was called Sharper Image. I don't know if you remember it. They sold novelty things from America. And so I had a mini basketball net that was about sort of 7 foot tall. And it was in my office. And Franco and I would play basketball for hours and hours on end because there was nothing to do. The market was so crapped out. There was really nothing going on at all. There weren't even great deals because the banks were in such disarray. And then slowly, after that period, we had a lot of cash. Well, for us, a lot of cash. And we started buying up bits and pieces, and then we were off again, off to the races again.
You've bought and sold plenty of companies. I think you've been on the board or CEO of 11?
Well, no, I've created 11 public companies, sort of been part of the founding group of 11 quoted companies. And most of them real estate, but some of them, like the one that bought Noddy and Enid Blyton and Agatha Christie, right? That was a separate publishing IPO. But yeah, 11 companies. And but I've sat on, oh God knows, 1,000 plus private company boards. But the public one's 11. Oh, no more. I've floated 11. I've sat, because I'm sitting on one that I'm not counting on that at the moment. So a lot, yeah. But it doesn't really mean anything. I mean, it's not. I would never sit on a public company board unless I owned a lot of shares in it. I just wouldn't do it.
Yeah.
Because for me, it's people don't realise that non-exec directors carry exactly the same liability as executive directors. But in terms of day-to-day operational control, they have pretty well none. So it is if you consider the risk profile, it is not a good job to have. You get sued, if the board gets sued, you have the same liability as the executives, who are the ones that you might be being sued about. So I wouldn't do it unless I'm a major shareholder and in the thick of it.
Yeah, and we'll come on to that maybe a little bit later in terms of the conversation. But you've got a reputation of kind of calling the market time and time and time again. Talk to me about that kind of next period in terms of kind of growing and kind of investing in allocating capital.
First time is jammy bastard, right? And I described to you before how it was good fortune because I didn't know, there was no intellectual thought going on other than how is it possible that banks can lend 110%? This is really about as basic as my thought process was. Banks are lending too much money, way too much money, and it's not possible that it was past the parcel with real estate. This one's buying for $1 million, selling for $1.25 million to a bank that's lending 1.4 million, then selling it 6 months later for 1.6 million that a bank's lend. And it was like past the parcel, and just common sense went, whoa. And that's why, so the first one was jammy. I saw this and I was lucky because if I was wrong, I could have missed out on another 100% in the market. But every property crisis has been the result of a credit crisis. And, if you own real estate and you have no debt, it's quite hard to go bust, right? So real estate is about the risk of how much debt you have against that asset, and that will tell you or tell the investor their appetite for risk and how long they will live if markets collapse, because that part of the equation is the LTV, so the loan to value ratio, and the higher up you get, the more your risk. But it's great for returns on equity if markets are going up. You can make huge amounts of money. But if markets are going down and you're 90% levered and it goes down 10%, you'll bust. So every real estate crisis has been the result of a credit glut. And so if you look at the GFC, if you look at, even go back to the 70s, the secondary banking crisis, through to the 80s, through every single one, there is too much credit. And therefore, we'll come on to probably what the risks are in the market later on when we speak. But for me, I was obsessed with the credit markets, not with the property markets, because the more available the credit, the more uneducated the buyer was. Because if any buyer can walk into a bank and say, I want to borrow 80% loan to value against this property, the question wasn't, what do you know about property? It was like, sure.
Yeah, because they've got to get that out of the door.
Right.
And it's competitive, and they'll write the fees down and extend the LTV to kind of...
And if they're conservative on their LTVs, the banker's going to get fired. So you can't be. And so there was this kind of snowball effect of banks wanting to outcompete each other. And as we saw in the global financial crisis, they were lending hideous amounts of money. And I know because we were borrowing. But where I'd like to think we were kind of smart, or at least smarter, was that banking isn't just about LTV, it's about the covenants. And the easiest way to explain that is I can be 90% geared on a piece of land. The operational gearing of a piece of land is the land could be worth 10, but what you put on top of it, the enabling works and the construction, could cost 8. So I'm in for 9 and my end value is 10. So if I'm, let's say, 90% geared on cost, which is 90, I'm 80, I've got 81, I've got 9 million of equity. That 9 million, if the value goes up to 10, means I've doubled my money. Okay. If it goes down, I'm bust. So what it means is the value of that land is hugely susceptible to the gearing, the operational gearing of the investment. The development. Investment, if I'm 90% geared, but I've got a 25-year lease to the government, okay, with upward only annual rent reviews or to RPI,
yep,
and I've got no LTV covenants, in other words, say I take a 5-year loan or 10-year loan or whatever it is, and there's no potential breach because effectively I've got a gilt,
yep,
it's okay to be 90% geared, because even though the values might come down, the chances are they're going to come back up again over that 10-year cycle. So the covenants become primarily important. What is your LTV? What is your interest cover? What is your repayment schedule? What does it look like if you have to re-equitize a deal? All of those things become much more important than actually the underlying real estate, because the underlying real estate you're buying because you think it's a good deal, you think rents are going up, yada, yada, yada. But you can't control the macro. You can't control the economy. You can't control whether people are going to want 5,000-foot industrial sheds in the West Midlands. That there are bigger factors that are at play. But what you can control is your spread of debt, your spread of income, all the portfolio management stuff. And as I was saying, the debt covenants become absolutely pivotal. And to this day, some pretty smart people that I know, I ask them about their covenants, and they're so lacking in understanding of what the covenants are. And they don't even understand that they can't make good on some loans. So what does make good mean for those that haven't come across it? Let's say I have a property and I'm 70% geared. So it's worth 100. I've got 70 of debt. I've got to maintain a maximum 70% LTV. The value dropped 10%. I'm automatically in default. So most people would go, okay, so if I put enough money in to get the debt down to 70%, the LTV down to 70%, that would be okay. I'd be able to do that. But they don't realize that the banks won't let you do that. The bank is controlling that scenario. There is no right, unless you have a make good provision in your debt agreement, the bank doesn't have to do that, in which case the bank can say to you whatever it wants. No, I want repayment. You're in breach. I want repayment. And you go, why would you want repayment? You're only 77% geared now, or whatever it is, and I'm offering to pay off that debt, because you can't pay off the debt without penalties. So the bank has literally got you. And then they basically strip out some of the economics, and the bank will turn around and say, tell you what, you were paying a 2% margin, you're now paying a 4% margin. If you want to go ahead and refinance, go ahead, but you're going to pay us early prepayment fees. this optionality that the banks have is quite brutal, and people naturally assume, oh no, we'll make it good from. And the other natural assumption is they have too high gearing, and they go, but we've got lots of different assets, so even though they're non-recourse borrowed on each one, they go, it's not a problem, because if that one breaches, I'll borrow more against that and pay off that debt. Or, of course, what normally happens is markets aren't that forgiving. It's not that one goes down in value. It's that they all drop down in value at the same time, and you can't refinance anything, and then you're bust.
Did you learn this the hard way, or was it just merely an observation, and it was more about looking at real estate as a widget, right, and not being emotionally attached to assets, but clearly being very tight and very critical around like the credit worthiness or the kind of the debt markets in terms of how you applied that to your portfolio and assets?
I've been lucky enough to always surround myself with super smart people, much smarter than me, and Sandy Gunn was for many years my CFO, and she's brilliant, right? And debt is her thing, in particular, and she's brutally tough and amazing. And even though when she first joined, she joined us as a financial controller, and then sort of when I left Berford, eventually, she came with me and became my CFO and partner, and she recognises these things well before I do. She points them out to me. And so most of it was her guidance, but some of it was hard experience. It was just sort of, learning through being on the wrong end of the trade and having to get out of that and pay a price for getting out of it. But I think it was her influence more than anything that kind of, and to this day, I don't really sign off any debt agreement without Sandy's okay. As I say, she's really, and you can't, I think in real estate, I suppose it's the same in any business, unless your finances are absolutely robust and you have really good financial controls, you're going to struggle. And for me, Sandy she's just watched that corner, so I never have to worry about that, which is a massive relief for someone like me who wants to get out and hustle and do real estate deals, not to have to worry, to know I've got someone of that caliber who's, she gives me a hard time. She challenges me like no one else. Sometimes Oprah challenges me. If you're listening, Sandy. No, she's amazing. And, equally, I've worked with people like Mike Brown, who is one of the best, most cerebral real estate thinkers. And if you get the chance to interview him, you should.
Is that the professor?
We call him the professor, yeah. Yes, because he is like the professor. And he talks like a professor. And to get to the end of what his thought process, you have to stay with him to go from A to B to C to D, to follow his very logical brain. Whereas I kind of like to go from A to F. He's very methodical, and he's got a super brain. And again, people like Franco, he saved so much of my time by being a sort of gatekeeper to deals. And I know a lot of agents have complained to me, I can't get past Franco, but the reality is Franco dissects. He knows what I want. He knows my brain. He knows how I think. So he only delivers deals that
fits the criteria.
Yeah. And 9 times out of 10, he's absolutely right. And then it's a question, can we make that deal work? Does it? And so, Nigel, in my early days, in terms of understanding public companies, shell companies, he was my maven, and I've just been very fortunate. I've surrounded myself with very smart people.
Yeah, I was going to say, you mentioned Nigel, Franco, Sandy, Mike,
Tim Evans. Tim Evans was, again, Ben Walford was the young boy. He's now a man, who I'm backing today. Tim, super amazing real estate brains. And I just met these people along the way, and perhaps my skill set is going, I want that person, or that one.
I want that one on the team.
And getting them and keeping them, So our team was together for, I mean, Mike was the new boy and we were together, I don't know, 10 years, 12 years. The rest have been with me 20, long time. And it's because I think we're quite effective. And we're all, the last team that did, what was the last, that went into sort of Max, then our long income business that became LXI, that became London Metro. That team, we were almost dysfunctional in the sense that everyone had a completely different mindset in sort of, so our meetings to discuss stuff were like, I suppose we were the equivalent of the Radiohead of real estate. We were all coming at it from different angles, and there were lots of intense discussions, but we all kind of ended up in the right place. And I love that. I love that. If you can love dysfunctionality, I love that in the sense that you need to be challenged, because if you're not, you'll end up making mistakes. If you think if you're arrogant enough to think it's your way, no one else's way can work. And I have often thought that, but I've been brought down to size by some very smart people kind of going, well, there's this, that. And in the end, you have to kind of go, bollocks, you're right. and
thank them later that you didn't lose a lot of money on it or what have you.
Yeah, and sometimes I've regretted giving in because we've missed out on deals that I feel I should have fought harder for that ended up being okay. So it's not, there are plenty of deals that we should have done that didn't do, but you can't do everything. And the ones we did do, we did very well. So on the whole, but my goodness, it was, and I think maybe part of the success of our team, and I don't take credit for this at all, because it was, we were just some guys sitting around a table discussing, and Tim's depth of knowledge dwarfed mine in terms of, what he knew about what was going on in the market with whom, but it sort of didn't matter. At the end of the day, you kind of intuitively, I thought this is something we could do. I was very market feeling, knowing what the debt markets might want, knowing what the investor in PLC world or club members, when we had private clubs, what they would want. And it just worked. I can't really explain it, and I suppose if you could turn this into some sort of juice or oil, you'd be flogging it and making huge amounts of money. I don't think life is that simple.
Any kind of glaring lessons or deals you look back on, that you think, God, I got out of that one just about okay, or that was a big lesson?
I think every deal's a lesson, and I think that the world is changing. I was brought, my career spanned, or most of my career spanned, a period where real estate was doing this, up and oscillating, but the trajectory was north.
So you could call the market, but also the market would bail you out sometimes.
Right. So it became a sort of, can you hold on? And that's often what real estate's about. Can you hold on through? Can you manage your way through a crisis? And when you stress test these things, like we stress tested our assets a lot. We stress tested our debt a huge amount, probably abnormal amounts. And that was because I was terrified of losing everything and going back to a bedsit in West Hampstead. I was terrified. So we stress tested, and sometimes we would go 20%, 30% for what would happen in that world. Bear in mind, we thought we bought cheap anyhow. So if the prices went down another 30%, how would we survive that? Which I think held us in good stead. But the GFC came, the global financial crisis came along. We never stress tested 50%. No one did. And so when it happened, no one knew what was going to happen. The banks, it was just absolute, it was blood on the streets, and no one knew what was going to happen. But if you can work out, our stress testing ultimately over our portfolio was non-recourse debt there, non-recourse debt there, non-recourse debt there. So they could only ever come back to that asset group. And actually what happened was our assets were really good, over-geared, but really good. So the bank came to us and said, I tell you what, you've lost your equity in that, but can you help us work this one through because the assets are too good to be able to flog. And we did, and we bought more equity in, and we ended up turning what was, very little equity into significant equity. So you can manage your risk profile in all sorts of different ways. But what I was saying before about, my career was through the oscillations, the trajectory was generally north. I think we have been through certainly one paradigm shift in this movement from retail to logistics, where it didn't matter what you did in retail, it was going down because suddenly no one wanted, Amazon comes along, no one wants to do physical retailing, it's too expensive, rates too high, yada, 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 costs are too high. And so retail was just devastated. You saw unbelievable cataclysmic changes in retail switching to logistics. When I started in real estate, 30 to 35% of any institutional investor's portfolio would be retail. Today, I don't know what it is, 1%, 3%, 5%, I don't know. It's tiny. It's tiny. And the question as to whether we're going through a paradigm shift in offices remains to be seen. And because the way in which we use offices has changed so much. But there are very few paradigm shifts that happen in property. But the nature of real estate now is I can't sit here with any confidence and kind of go, whatever you buy today in a more distressed market, not distressed, but weaker market, in 10 years' time is going to be worth more money. When I started in real estate, you could almost guarantee that. So all you had to do was hold on, because the market, you'd go through the oscillations, but you'd end up, if you could afford it, you'd end up being okay. Doesn't happen today. I think today we're in a market where if you're not careful, you could think you're buying cheap today, and in 3 years' time you could have gone, oh my God,
What have I done?
Yeah.
Talk to you about this in Catherine's Docks deal, because you bought it for 150 odd, and then you sold it a few years later to Blackstone for 450.
Yes, I'm not sure that was the exact. It was sold as part of we sold the whole company actually. We bought St Catherine's Dock out of pre-war receivership, and it was a little bit of a mess. And what I've always loved is taking messy assets. It's always been my MO. And this is the business part of what I really liked about real estate that I lost over the years. You buy someone's worst nightmare. They've got problems everywhere. They cannot wait to get rid of it. You buy it cheap, and then bit by bit, you transform it, you change it, you turn this 1 million square feet I mentioned in Manchester. It was Eagle Star gave it away. There's 1 million square feet we bought for 3 million quid with a vendor mortgage for 2.6 million pounds from Eagle Star, which is a huge insurance company. They could not wait to get rid of it. We sold that for 18 million pounds, which for us was like enormous. We put in about 600 or 700,000 of equity a few years later. But I went to live in Manchester, and I was literally hustling office rents, letting space, going out, finding people, filling up, going to a pharmacist saying, I'll tell you what, we need a pharmacy here. I'll pay for your shop fit, finding a local one. Actually, the guy we found, I think, was from, I don't know, it was Didsbury or one of the satellite towns, and finding office tenants and going and literally seducing them into our building, and off the cheapest rent. They were never going to get a deal like that, but we bought it so cheap. And then we filled up 260,000 square feet of space. We had one anchor tenant there, but even they were on a short lease. But I just filled it up, and that's where your selling skills come up. That's where my education selling umbrellas in the markets actually helped me, because people forget when you're in real estate, you're flogging space. That's what your job is, to sell space. We can make it look very glamorous and but whatever part of real estate you're in terms of, if you've got a building, you want to get the best income at the best price in the best location. And that's what I was doing in Manchester, and just literally with a couple of young agents, just filling up this space. And I learnt so much about, also, it's 1 million square feet. It had a 5-star, the only 5-star hotel in any city centre outside London. And it was an absolute terrible hotel. Why it was 5-star, I never understood. But, car parks where cars were being stolen. I remember being woken up in my flat in Manchester, which was a no-go area in those days in the evenings. And the police were at the door, and I was like, uh-oh. And they said, look, we've got some good news and bad news. I'm like, well, what's the bad news? Oh, no, what's the good news? We found your car. I was like, okay, I didn't know it had been stolen. And what's the bad news? It's in the Mersey, so the River Mersey. So, it was a horrible place to be. But I transformed this, and I literally was living there, and I was doing it on my own, and it was brilliant. I learned so much. And so to this day, sorry, this is a very long-winded answer. St Catherine's Dock was the perfect thing for us because it had been neglected. It needed some TLC. It needed some innovation. It needed a bit of money and repositioning, and we could do that. And then we substantially refurbished one big building of all the buildings there. And, it's the only private marina in central London. And I love boats. And so it was, we actually commissioned some houseboats to be built, modern houseboats. And we were renting them out, sort of like the film Sleepless in Seattle, if you've ever seen them. And it was a great fun project for us. And so we transformed it, built the income up, and then sold it as part of when we sold Max, which is a public company that we listed in 2008. I think it was 2008. Yes. Which was of itself an extraordinary story because the global financial crisis had happened, and
you'd sold out just before that, right? Again, you'd sold out, recapitalized, we were able to raise a load of money.
Well, in 2008, we went to Morgan Stanley and said, we want to list a cash business to take advantage of the GFC. And no one was doing IPOs. No one was raising money. People were still, they were absolutely in dire straits. The banks were in the process of writing off 50 billion of loans. It was really carnage back then. And Morgan Stanley, to their great credit, said, you've got a decent track record. Okay, we'll sponsor you. And we raised 220 million quid, which doesn't seem like a lot of money today. It's clearly it's a lot of money, but I think we were the second or the third biggest IPO in Europe that year, raising 220 million pounds. We obviously put in money ourselves. And then we went out and went shopping. That's when I joined up with Mike, and obviously Sandy and Tim and Ben were already there. And we just went shopping, and we were able, it wasn't a big window post the GFC, it was probably only 12 months, but we were able to do some extraordinary deals with cash. But raising that money was, and St Catherine's was one of those deals, was probably one of the greatest achievements that I've had, because no one could raise money. So it was a great, confidence booster. But then you kind of go, oh my God, I've got all this money. What if the market's going down again?
Yes, there's a theme here, that kind of, is it imposter syndrome or that self-doubt?
No, well, definitely imposter syndrome. I think most successful entrepreneurs get that quite a lot. No, it's more, what if I get it wrong? It doesn't matter so much, it's my money, but I've got other people's money, and I would hate that responsibility. It would be, I can't, mercifully it hasn't happened, but I can't imagine what that would be like to sort of lose a significant amount of other people's money because you've been reckless or done the wrong deals. And I suppose that's what focuses your attention. Doesn't make me a great guy, by the way. It just means I'm paranoid about upsetting other people. Probably makes me very insecure. But so it was a very interesting time. St Catherine's was a wonderful deal, but just more of the same theme. And by the way, what we did in Manchester, we did around the country. So in Birmingham, we bought one building called Priory and Cannon House. It's 400,000 feet. At the time, Sky had just come out, and we had Sky in all the common areas. And we had, instead of sort of cigarette smoking commissionaires at the front desks, we did up the front entrances, had coffee stations, put very nice God, this is an awful thing to say that, but for good-looking guys and girls in Donna Karan and, you know, elegant clothes. And we even introduced valet parking at a time when no one had valet parking here. My wife's American. We spent a lot of time in America. We had a home in America. And I thought, great, let's have valet parking. And it was very funny because when you're marketing buildings, and this is one of the phenomena that applies to resi as well as commercial, why does every residential apartment building you have gyms and saunas and steam rooms? Most of the occupants never use them, right? But they love to tell their friends, got a steam room, sauna, a gym, and all these facilities, but they don't use them. Very, very rarely. We cottoned onto that quite early. So we had all of these concierge services, including valet car parking. And that was quite funny because people would turn up to be valet parked and kind of not realize that they had to give the valet the key. So we had some sort of tug of wars at the entrance to Priory House where people were like, the valet was like, can you give me the key? I'm not giving you the key to my car, mate. But I've got to valet your car. I've got to take it and park it. Well, I'll park it, thanks very much. That's not what, you know, we had this process. But we had, and we learned very early on there's a lot of marketing. You know, you can do refurbs and spend a lot of money, and you can do inexpensive refurbs and make them space look great for a fraction of the cost.
It's all about flogging space.
Yeah, flogging, marketing, getting the right product for the right, and making sure your in cost is right. It's all about the buying. Property is not about the selling. It's about buying and making sure your in cost is the right cost. That doesn't matter what happens, that you're always going to make money out of it. And I think that I learned that inadvertently. I didn't start with that message. I learned as we went along, your capital value cost per square foot is kind of everything, you know, because that determines how much money you need to make to get a return. And even, you know, buying 130 travel lodges, it was always about the replacement costs of these hotels that we're buying is way more than we're paying for them. So it's quite, you know,
it's quite hard to lose money on that when you've got a 25-year plus lease and the creditworthiness, et cetera, et cetera.
Right. It's not impossible, but it's less likely. So and that ignores the cost of the land. So your replacement cost is way above the physical, just construction costs. You've got the land for free and you've got part of the building for free. But these are not rocket science. These aren't deep-rooted economic real estate.
Yeah, and I've had other people on the podcast who've said that before, but there's one thing saying it and there's one thing being disciplined with it time and time and again. And I guess, you know, that probably leads us on to Secure Income REIT, LXI, you know, and also onto London Metric, just in terms of the risk profile of that business. Can you just talk to me about why and how and the journey of that?
The long income business started before the GFC and was really not what I had spent most of my career doing. Most of my career was blood and sweat, you know, and doing these real estate deals that really needed a huge amount of energy and hard work and graft to take a messy million square foot or 500,000 square feet and turn it into something better. It doesn't matter if it's an industrial estate. We did it, for example, in Erith, in Kent. We did it in Haywood, in Manchester. You know, it's taking a product that you can turn into as an ugly duckling and turn it into a swan that someone is going to pay you a lot of money for. That's really what I had done. But we had the opportunity to buy some long income and very long income on created sale and leasebacks. And, you know, through a long-term relationship we had with Blackstone and continues to this day, but and with other private equity houses who we just known well. I'd grown up with the people who are now running these places, and we were able to structure some very significant deals. But going back to what I said before about leverage, you know, we had a bank that was literally in Bank of Scotland that was willing to write checks for 80-90% debt for 500 million pounds. You know, it was that easy to do that. So I kind of went, we've got an amazing credit for 30 years. You've got RPI or fixed annual uplifts, upward only, and great real estate where the earnings cover to the rent is significant. Let's put a little bit of equity in, let's lever them and watch what happens. And the first few years, they performed amazingly because our levered return was just kind of bush. And then the GFC happened. And then some of the portfolios, the trading of the underlying assets, these are key operational assets, and we only buy mission critical assets where the company needs to have that. Merlin couldn't go out and replace Alton Towers somewhere else, or Thorpe Park. You can't, if you're in a hotels Travelodge business, you've got a business a hotel that you save us to obsolescence. You kind of need to keep functioning, or you haven't got a hotel in that location. And hospitals equally, they have to keep paying money, investing money in those hospitals, or they ain't going to do any business in the hospital and they'll lose their rating. So it just seemed to me like quite an interesting space for a highly levered return. And so we had a club, we put in 100 million, and we got 4 investors to commit to put in 100 million. We'd only spent about 260 or 270 of the $500 million that we had. And we'd bought a lot of these assets, they were performing really well. And then the GFC came, and then we got highly stressed on the LTV covenants. But we were lucky because Sandy had negotiated some very smart LTV covenants, and we worked with the banks, and we worked with some, the people who came in to sort of run the distressed book were pretty smart, because they recognised in our assets, these weren't development sites or crappy investments. Yeah. These were long-term strategic investment properties. And and that became, we just worked them through and re-equitized them and then refinanced out the banks, and took a few years, but they turned into what they did do is they proved their longevity. If you go through the worst financial crisis in living memory and they come out whole, you're doing something right. The leverage was wrong. And so today those portfolios, for the most part, still exist, and the bulk of them are in London Metric, and they have proved to be unbelievably resilient because they're mission critical, because they're key to the operations of that tenant business, as opposed to an office building, whereas we're in here in this office room, and if it gets too dirty or too it becomes outmoded, or in some way the services aren't good for you, the air conditioning doesn't work, you can just pick up and move next door. This is not mission critical to you and your operation. You can't do that with a hospital. You can't go, I'm just going to pick up my hospital and move next door. You're investing all the time in new plant and machinery and refurbishment, and you've constantly got that, and the location, the geography is critical. So it seemed like a sensible business, but it's a much more risk-averse business to the business that I was in, that I was used to. And so, but we did some of that as well, but just in different vehicles.
And then talking to you about the kind of the London Metric exit as well. How did that come about? Why the timing?
You mean LXI exit?
Yeah, LXI exit.
Well, the LXI merger was a merger of sort of two businesses doing similar things. And then London Metric was a natural, in today's equity world, to be on the global to be in the real estate investor universe of the biggest global institutions. Even being £1 billion today, you're probably too small. 2, you're starting to get noticed. When you're the size of London Metric, you're absolutely being noticed, even though in the pantheon of US REITs, you're still a baby. Nonetheless, at 4.5, 5 billion of net assets, you are recognised, and therefore you have a bigger investor universe. You can get cheaper financing. You've got the widest possible, as I say, equity investor base to talk to, and as you enter certain indices, the tracker funds have to come in and have to own you. So there's no point being small. So the whole point of Secure Income REIT was to use that as the basis to piggyback to bigger, and to be bigger. And quite frankly, London Metric needs to be bigger, and it's done very well at getting bigger. but there's kind of a limited
takeout, pool of takeout
exactly,
options.
and so that's a challenge for the guys. So they have to do it piecemeal. They have to buy assets, and it takes longer, but they're very disciplined and very good. That team, I've never ceased to impress me, and rather sadly, they totally don't need me or my input because they're just very, very good at what they do. And so if this is a business which produces at the current share price 6.5% dividend yield. The rents are going up somewhere between 3 and 3.5% per annum. So at NAV, you've got a TSR of 9.5% compounding. That, to me, in today's world, may not sound very exciting to some people, but I think is incredibly attractive off a 35% LTV. I'm not here to talk the book, but I have a very substantial part of my wealth in that business, and I can only show people what I do, what I elect to do with my money, not tell them what they should do. But that, for sort of a significant part of my personal wealth, is important, very important, and they run, I think, an exemplar business. At some stage, I can't see it in my time horizons at the moment, the world is going to want to have sex, blood and violence in real estate again, but it doesn't feel that's round the corner,
Yeah, I was going to ask you, what's your take on the market right now? As we're recording this, there's a budget which Rachel Reeves is going to deliver tomorrow. So we don't have the benefit of knowing exactly what's going to be in that. But if you take a bit of a step back, what's your take and what's your view on the real estate market right now?
We don't know what's tomorrow, but we do know that this is the most financially illiterate government in my lifetime that I have ever seen. She doesn't have a clue. And 1 minute she's putting up income tax, and 1 minute she's taking away child cap benefits, and this heating, but literally they don't know. And you'd love to think there's a plan. One thing I'm absolutely sure about is that tomorrow will be a bit of a damp squib, because she's clearly going to attack lots of different things, and it will be, it won't cure any problems. It might cure a short-term issue. There's only going to be another council tax band, or call it a mansion tax, whatever you want to call it, for higher value homes. And quite frankly, that would be the only sensible thing I think she's going to do, because it is slightly ridiculous that you can be in a 5-bedroom flat in Mayfair, house in Mayfair, and pay the same council tax as a 2-bedroom flat or 3-bedroom flat. It just doesn't make much sense to me. But other than that, I think it's going to be a bit of a damp squib, other than this government proving that they're anti-business, and they are. And so, it's very difficult to mask the hard left influence on this. So what's the future? I think under this government, it's pretty bleak. I would love to be able to sit here and go, no, I can see it's going to be amazing and things are going to change. And I think if you have lots of cash and you have a desire to be in the market, to get some exposure to real estate, you'll probably be able to pick off opportunities, because I think if there's one area that I think threatens, it's the private credit markets. I think there is a shadow banking market, which no one knows how big it is. No one knows what the behaviour, it's done very well.
The last few years, it's grown massively just because what real estate equity hasn't made sense.
Right. Equity hasn't made sense. Mez has, because you can get 13, 14% carried interest. But what is happening now is more and more Mez funds have been raised, but they can't generate the same returns they were making before. And the old funds have got to come to an end, and they have to be financed out. So something's going to have to happen, because institutions and investors want their money back. They want their money back. They've gone, okay, the property market's now not going up anymore, therefore we're not building the cover. It's already come down 20%. We're worried it might come down more. Therefore, two things can happen. We're going to charge you even more money for the debt, or we just want our money back. As I say, that it's such an unknown what's going to happen, because if there is no refinancing opportunity for the private equity, the private credit lenders, and we don't know how big, it could be massive, this market, then what are they going to do? Are they all going to want to sell? Because if they do, who's going to buy it? And how are they going to fund it? They're going to go back into the same private equity to borrow it off the same cost of money. So their equity, the sponsor's equity, is probably gone or nearly gone anyhow.
And they don't have any additional equity to invest because they're over allocated to real estate as a sector anyway.
Correct. Or they just don't want to put more money in because they have no confidence in the future. So I don't know whether that is a systemic risk or not, because it's very difficult. You know, I sat on the Bank of England property forum, meets once a quarter for many years, 5 years. And all we discussed was bank leverage, okay? Because we knew what the banks were. It was regulated, so you knew how many clearing banks there were, what the total debt was. The fact that they were over exuberant and the bank let them all borrow huge amounts, you know, it resulted in, of course, what we have today, which is they are so tightly controlled that the LTVs are all rigid and what capital weightings of the banks are incredibly rigid, so they all end up with a homogeneous product. But this spawned the private credit markets, and this money has just flowed into it, mostly through US op funds, actually. And as I say, we don't know how they're going to act when they can't refinance. They've seen values come down 20%. Having seen them soar up probably by 50, they've come back 20, and they have to refinance. Now, the equity bit went up and everyone was great, and now it's come down, and it's almost like the air coming out the tires. It's getting smaller and smaller. And if they have to refinance, but can't sell the asset or can't sell it at the current pricing, they have to accept a lower price. The sponsor goes, well, I'm out. I've got no equity in it at all. So I don't know what that means but it doesn't sound good.
Yeah, and to your point earlier in the conversation, in terms of being able to spot these trends, you know, it's looking at the credit market and seeing what's going on there, and then that informing your decision making or view on real estate. And you've kind of identified this shadow banking market that you said no one has really any clue in terms of the size and scale and risk profile of that.
And that's the point. It was the risk profile, the nature of the assets against which they're lent. Because if they were all long leases to great covenants, you go, doesn't matter. There was a clearing price for this stuff. But if they're lent against offices, secondary offices, and they were bought really, really cheap, and they now think they're worth, they were 10% in suburban London, or even probably in London, parts of London, and off current market rents, and they thought they were going to be worth 7 or 6, and they're not, then what happens? They're still at 10%, and they have to be refinanced, but the debt markets are shrinking. You know, they're not there. And the debt that is there now is going to be bloody expensive because it's on its own.
And the occupational story is, you know, going down, or, you know, the rise of AI that maybe we'll come on to in terms of your views, and like the knock-on effect in terms of AI agents and kind of roles that are shipped up, you know, to regional parts of the UK to do some of the kind of heavy lifting will probably be done by AI agents, and you might even not need that space.
And that's a very good point. You know, the macro is quite confusing. There's a great book by an economist called Nabil Rabini, who predicted the GFC. He's American, Iranian, Jewish. He's one of the great economists because I can understand what he writes, as opposed to most economists who I lose in the third line. And he's written a book called Mega Threats, and it talks about it's not in relation to real estate, it's in relation to everything. So it takes banks, it takes shadow banking and the private leverage market, which, as you know, has collapsed over the last few years. It takes societal threats, takes religion, you know, extremist religion, and it takes AI, and it kind of looks at all of these things and goes, national debt being, of course, a huge one, and it goes, where are we going? What is the direction of travel? And it ain't pretty reading. It really isn't pretty reading. And living outside the UK as I do now, I speak a lot to people who deploy international capital. They have a lot of money that they get. They can go to North America, they can go to South America, they can go to India, they can go around the world, or Europe, and not a single one of them has any interest in the UK at all.
Really?
Yeah, not.
And to be clear, you moved to Monaco, right? And was that because of the government, or was that kind of, a personal decision before that?
I want to be careful how I answer this. I decided to semi-retire, and we've been married. This is our 40th year of marriage, and we wanted to do something different. That wasn't the driver. The driver was, we don't like what's happening to London. I've lived in London for my entire life. Okay, it wasn't tax. I've never done an exotic tax scheme in my life. Literally, not a single exotic tax scheme. I pay my tax. That's it. It's part of the. It's my privilege. I'm the son of a Holocaust survivor. Or a fleer of the Holocaust, and I basically am very honoured and privileged to have been able to live here as a British Jew for my entire life. But I didn't like and don't like what's happening to London, and this has been my home. And I think so. We started looking around for two things: new adventure in our lives. Kind of, I'm in my 60s, and so we wanted to do something before I can no longer do it. And we wanted sunshine, and we didn't like what was happening in London. And so we looked at Portugal, we looked at Spain, all the places that people are. We looked at Italy, and the reality is that Monaco ticked so many boxes. Primarily, it's very, very close to the UK, and we've got my kids and grandkids here. And so in an hour and a half, you can be back in the UK. But I do mix with people there who deploy their capital, some very wealthy people who deploy, I'm the tramp of Monaco, who have this capital, and when I talk about the UK, a lot of them roll their eyes,
They don't want to know about the UK, and that extends to the UK real estate market as well.
Yeah, it's a general. This government is anti-business. Look, in fairness, the non-dom catastrophe, and I consider it a catastrophe, was driven by George Osborne. It was the Conservative government that introduced that. And of course the Labour government has just continued that theme. I mean, George Osborne and his SDLT, on real estate, it was bonkers. I mean, it's absolute. I think he's possibly the worst. Has taken two of the worst decisions in my lifetime in terms of how it directly impacts London and its perception and the UK from outside. And the Labour Party's just sort of blithely Marxist-wise just continued the theme. And now, again, not allowing Conservative initiative, no tax relief offset for the private rented sector. So the buy-to-let market. And then kind of introducing now new rental protections, protecting tenants, having already shrunk the market from people who've gone, well, I know, like, if I can't offset my interest against my income, I'm not going to do it. And now this government is introducing rental legislation that's making it even less attractive, and then complaining about there's not enough rental properties. Basically governments are not full of intelligent people. They're full of academic people, but not intelligent people, not smart, not commercial people. And the Conservative government, and I have been a Conservative my entire life and heavily supported the Conservative Party, they're just disastrous. I think it's been a catalogue of disasters. So we decided that societally, I don't like the crime in London. It's out of control. The police is too, there's lots of social things. And as a British Jew, I know my community's felt desperately unsafe and ignored, and has, well, you can see it on the streets. Even 2 days ago, outside a synagogue in North London, it's like, what on earth these innocent people who are just British civilians have got to do with other people's views of what's happening thousands of miles away in Gaza? I don't know, but these people were like bullied into by a huge protest outside the front doors of a synagogue. What were they doing? Praying? I haven't noticed Jews being terribly violent or very, it's pretty scary. So that's a very long-winded and very honest answer. And so Monaco ticks lots of the boxes. But going back to the point about international investment, the UK doesn't look very attractive. Our growth is negligible. But to be honest, Europe's growth is incredibly anemic now. If you look across you might say, well, Spain's doing a bit better this quarter, or Italy's done better because Meloni's come in and done whatever. But if you take Europe as a sort of macro, it's in a pretty pitiful state. I mean, the powerhouse Germany is in reverse. It's kind of worrying, but that's what happens when you have you have a seemingly benign society that wants to look after everyone and doesn't like wealth, and it becomes increasingly left-leaning and doesn't recognize that you can only afford to look after society if you nurture wealth creators. And we've sort of pivoted and sort of swung towards really not liking wealth creation. Really, even middle-class people for a long time, especially young middle-class people, find capitalism repugnant. The GFC was caused by capitalism, and it was nearly the end of capitalism. And it's flawed, but it's a heck of a lot better than whatever else is out there. And so Europe is now struggling, and I really don't see how it gets out of this, because it can't manufacture. Someone was telling me the other day that a Volkswagen Touareg in Monaco, or in France, sorry, now costs 92,000 euros, right?
Volkswagen.
A Volkswagen Touareg. It's sort of an SUV. And this is a friend of mine who's had a series of them and just happens to love them for when he goes, whatever does off-roading with them. And he said a BYD.
Yeah. Chinese.
Which I knew nothing
car.
about. He said, I went to see one. He said, and honestly, he said it was like so much better quality, so much nicer, so much better, better equipped for 33,000 euros. And then he told me that BYD is building a factory in whichever province it is in China that's bigger than San Francisco. It's 50 square miles, a factory. And I was like, God, what the European manufacturing base, where, it's cost of capital. Ultimately, if everything's being built by robots, then it should all cost the same, allowing for the the cost of materials that go in. But the problem is in China, they can build these things with a very low cost of capital in the construction process. So actually what they start with means they don't have to recover that capital. In Europe, you've got the cost of building these things, the cost of creating this automation, which doesn't yet exist on the scale that it does in China. The land costs are hideous. And then you've got to feed a welfare state, which China is the state, so that money is effectively the state. And I don't know how that's sustainable. I don't understand how the enormity of what happens. And against that, you have a radicalization of parts of society that not only hate, feed off that society, but hate the society, the culture of that society, hate Western values. And there's this clash going on, and I don't know how that plays out into real estate or the long-term future. I suppose we're always going to have to deliver goods. It doesn't matter, Amazon's going to be there, logistics are going to be there.
Logistics and living, right?
Right. But I don't know. I think manufacturing's got to be dead in the water, because there are places around the world, in Asia and India and, that can produce everything so much cheaper than we do. And so even financial services, and we'll come on to AI, but I mean, AI is going to, hugely change our society and working, and therefore must change real estate.
Yeah, so we've spoken about a few structural changes, some headwinds, and some kind of views on what's going on geopolitically. Layer in AI over the top of that. What does that mean for raising, deploying, and managing capital earmarked for real estate?
I'm going back to Nabil Ravini, and I do recommend people read Megathreats. He basically thinks that the top 10% of society, in terms of the smartest 10% or those in the right places, will have permanent jobs, will be permanently employed. And the bottom 10 or 15% who are doing jobs that the internet can't replace, that AI or supercomputing or in due course quantum computing, cleaning a toilet floor might be capable of being done by a robot, but the reality is there are jobs that have to be done.
Plumbers, electricians, engineers, things like that. That
have to be done by things that cannot be replicated easily, and not for many, many years, by supercomputing. So what happens to the people in the middle? Okay, what happens to the
80%?
Yeah, or if he's wrong, 50%, 70%, 60%, what happens to those people? And I'm not sure that process hasn't already started. Like 125,000 more people were unemployed last month than the month before. And I'm wondering if that's, some people say, yes, that's the cost this government have imposed, national insurance, more taxes, more costs on the employment legislation. So employers are not taking on as many staff and are rationalising. But maybe this is the start of that process where AI is taking over people's jobs. Look, Ernst & Young, I think it was, have cut their workforce by 20%.
Yeah, a lot of them have culled their grad schemes.
Not just grad schemes, but qualified accountants, because annual audits, for a large part, can be done by AI. There is a lot of things. If you think about real estate, and I'm sorry to all the lawyers out there, but leases are such an anachronism, but they keep lawyers employed. Like, we don't need leases. We can deal like most other countries do, modern countries, with a common whole, a tenancy agreement that is so standardized and it can be tweaked and adjusted. We don't need super qualified real estate lawyers to do all that stuff. Many, many legal documents, as you can prove on ChatGPT. Go on to ChatGPT and tell them that you want a license for occupation for an office of 3,000 feet that's got some furniture. You give the brief, and within a minute, 30 seconds, it will come up with the template of a lease or a license. And substantially, it will be correct. You probably want a lawyer to look over it.
But it'll hit 90% of...
But the more it learns and the more educated it becomes, the better the quality. And we're right in baby steps of this new transition. And people who say to me, this is like the Industrial Revolution took 150 years. This could happen in 5, 10 years. There could be mass unemployment, in which case, how do people live? And the answer is you're going to have some sort of universal credit that you tax the corporates that have the AI to pay for society, or society collapses. And that's another problem a challenge that I have with all the societal things that we've discussed, the macro changes, combining with unemployment, before you introduce a universal sort of credit system. It feels to me like a very difficult time to manage. And I know lots of young people, especially in real estate, young, ambitious investment agents who don't have access to this technology. If you're CBRE, you will be first, or Savills or Knight Frank, you will be getting the AI to improve the information flows that gives you an absolute marginal better service against a small operator who literally can't afford that software and can't adapt it and support it or whatever. So the data scraping, the data quality information is going to always improve the lot of the biggest operators, and the small ones are going to kind of, unless they're terribly niche and they can't provide the information. And if I'm a buyer and I want to use a small agent, my bank needs all this data. It needs the information. It needs the support, the modeling, the financial modeling. AI is going to do in a heartbeat. And I've got, there's a very example of a member of my family who's got a great business out in the Middle East, servicing African countries. It's FMCG, it's fast-moving consumer goods, and he's developed this amazing business. I'm very proud of him. And he had a few people, I can't remember, 4 or 5 people in his. He does perfumes and body sprays, and 4 or 5 people in the creative team that were designing bottles and the nozzles and the packaging, all of this stuff. He now has one.
Yeah. Google Banana Nano Pro or whatever it is has come out.
And that one person can produce enormous volumes of optionality, of options, modify within minutes, and so what are those people now going to do? If you're a creative in that, where are you going to go? What job are you going to do? Because what applies to him applies to anyone making a product.
Yeah.
And it applies to services as well. These things are going to change. And anyone who said, actually at the talk where you and I were the other day, I said that, again quoting Rubini, but he'd said you really must be invested in the Magnificent Six, the biggest tech companies, because they own the market. And there's been so much negativity about AI, saying
and the bubble
and the dot-com bubble, it's going to come to an end. And a couple of people have said to me, well, you probably spoke too soon back then. And I said, well, no, actually what I said was, that's what Rubini said. And I agree with him, but there's going to be times where it goes up, down, left, right, but it's all about trajectory. Don't ever judge a share price on its daily movement. Judge it on its trajectory over 3 months, 6 months, a year, 5 years. And it was interesting because there was so much press recently about the thing, and Nvidia came down 5%, then it came down 3%, and people going, see, it's all over. Well, Nvidia today is about 1% higher than it was when we spoke.
Yeah, because they overhit their earnings, didn't they?
It's 1% higher, despite the naysayers, despite the people shorting it. And you're hearing this massive hedge fund has come out of all its Nvidias, despite everyone trying to short the Nvidia stock price. The world is disagreeing. And it is fascinating to me because 1%, how long ago did we speak? 3 weeks? So 1% in 3 weeks. Now, if it does that every 3 weeks, okay, then...
You might need to sell some of your London Metrics shares.
And so this is about trajectory. It's not about short-term this. And people who think AI is overcooked and oversold, yes, of course, there'll be lots of examples you can point at. But if you own the space, if you own the territory, which they do, then, and you own social media, you are incredibly powerful, and it becomes increasingly more powerful as you get to the top. What happens to that power and where it gets used, deployed? Could it be militarily? Could it be politically? Could it be, is a bunch of other scary questions. But financially, what does that mean for real estate? What is that? How does that translate? And for me, it means less space is occupied. Logistics, ironically, I think is fine, because you need product. Are you going to stop AI or not? Are you going to stop ordering, Amazon packages?
Just have your AI agents that will do it for you.
Right, and it happens quicker, and the quality of the information you're getting on Amazon when you look at it. But is someone going to come along and replace Amazon as the supplier? No, they own the space. They own, and they will continue to own last mile delivery, and they'll own drones when they can, and that's just now so enormous. But you will want product. You need product. Anyone who lives needs food, needs bedding, needs light bulbs, and so there is a very strong argument that logistics is going to keep going. You still need a washing machine. You can't, AI won't do your washing.
Still need a bed and a roof above your head.
Right. And so, but offices, if I'm a firm of accountants or lawyers or creative design agency, or how much space do I need? Do I want an office? Yeah, I probably do want an office, because you still need intellectual spins that But what if Zoom was replaced by holograms and actually you were sitting next to people who were, it's like being next to people. You can see them flinch. You can see that we're some way off that. But does it mean we're going to want more space? I can't see that. I can't see.
Or maybe the space changes and it becomes more meaningful in terms of human interaction, which it obviously can't replicate, but it's still really important.
It can, but there are still less humans interacting. So
at work.
At work. Yeah, at work. Yeah, because, a room this size, we're in a room that's probably 12 feet by 14 feet. You could essentially do what you do in here at home if your home was big enough. But if you work with other people, you might still want to come to this room, but you'll just use it differently. Now, if you've got 50 people working out there and you only need 20 of them or 10 of them, you're going to shed space. So does the space work for you then? Yes, you'll change it. But it's already happening. You look at, this is a building, a serviced office building. I won't say who the service office provider are, but they're top-notch service providers. That's transitioned incredibly quickly. And people now don't want long leases. They want short leases. They want total flexibility. They don't want any embedded liabilities whatsoever. So we become like hotel operators.
But the trouble with the biggest getting bigger is who is their takeout. And obviously you touched on entry point in terms of buying real estate, but exit is also important when you're looking to kind of return and recycle capital to investors. When you get to that size and scale, there's only a few people that will write the check to be able to buy the portfolio, buy the deal.
So, okay, but you can't, when I'm talking about bigger, I'm talking about corporately bigger, but the transaction can only be a certain size. So if you took this, £100 million asset, it's only going to be £100 million asset. Now, if you're Blackstone and you're now $1 trillion business, which they are, they need to buy a lot of £100 million buildings to move their needle. That goes to the fundamental performance of Blackstone, and it gets harder and harder and harder. And when you're making a conviction investment, you're going, I want European logistics. You kind of have to buy billions and tens of billions of pounds worth. So you buy other companies. But that's not AI. Those companies will only ever be a function of earnings. It's not, and NAV is just going to disappear completely. We won't, in 10 years' time, no one will know what an NAV is, maybe even 5 years' time. It's all about earnings. Real estate is really just about income, driving
Credit.
income.
Yeah.
Well, just driving
income.
Yeah. So a serviced office building is a classic example where it doesn't matter whether your leases are daily or monthly. It's like a hotel. Yep. You're just driving income and you want the highest rent and the best location with the lowest costs. So property entrepreneurs or owners are going to have those skills. They haven't had them. In my life, it was all an FRI lease, sign the lease, see you in 25 years. Now they're working day and night to get value to you as a consumer and to them and to their shareholders, because they want the lowest costs, but they want the best products. And so they're like running
hence the rise of operational real estate as a term in the last few years, and kind of the interest in that as a wider sector.
So that won't be affected by, the service won't be affected by AI, but the numbers of people wanting to be in that building will be, because we've moved from FRI leases for 25 years to leases that you can break every 10 minutes with total flexibility. But the flexibility now is, if you're a company that employs 10 people, you can fire 5 tomorrow because you're shrinking because of AI. And that to me is why I think space, at least in offices, physical retailing is difficult because difficult to assess. Prime physical retailing, I think, is as strong as ever. People love brands, and so long as they can afford it and have money to, but when you start getting into more middle market, becomes tougher, and low end, funnily enough, becomes more resilient, probably the cheap and cheerful end.
Bell-shaped curve, two ends.
Exactly. The middle market, I think, is difficult, although Next seem to be defying the odds on that, but there aren't many Nexts,
So most people that I talk to who work in real estate are kind of optimists. You're clearly very pessimistic around it. And I know you're still, like you said, you've got a large part of your net worth held up in kind of London Metric. You still are an active participant. You still look into the market.
Still investing.
Investing, maybe backing others. Who wins when it comes to UK and European real estate in the next 5 to 10 years?
I wouldn't say I'm more. It's not that I'm negative on real estate. I'm more negative on European economy, the European economy, and it's very easy to generalise. Right, there are pockets in at every time, wherever the market is, there are pockets of opportunity, and the people who distinguish themselves commercially are the ones who find the pockets. So I'm surprised to hear you say that everyone you meet in property is optimistic. No one I meet in property is optimistic. They are hopeful that we're not going to fall off a cliff edge. Okay, I'd say there's a difference between optimistic and hopeful, and I think everyone is waiting for this budget with bated breath. But we've got 4 years left of a government that is anti-business and really doesn't like real estate. There is nothing in this government that that is going to make you like real estate. Now, you can be in BTR and a developer in BTR, and some of them doing really well. Some are doing well in each sector, but many aren't, and it's difficult, quite frankly, at any sector to kind of go, oh, well, that one's going to be really exciting, because I don't know what is really exciting. And so I think markets tend to go up or they go down. They rarely stay the same. So my mindset at the moment is the market's probably going down and the air's coming out of the tyres. But in every market, there's opportunity. So anyone who's got access to capital, anyone who's overgeared is probably in trouble. Everyone who is, no, not probably, is in trouble. Anyone who has access to significant capital is probably, and is out there hustling, might find deals over the next 12, 24 months, because the market is going that way. I think some people have bought things recently and will end up regretting having bought them. But hey, you know what? I could be totally and utterly wrong. And part of me hopes I am completely and utterly wrong, because I want the market to, I want everyone in real estate to do well. I just have to be honest about
how you see things.
And I'm personally, I'm long on cash. I don't, or near cash. And my colleagues and I look at a lot of real estate and find it very difficult to get excited about it. We had a deal yesterday, funnily enough, an industrial deal, messy sort of industrial estate, and we bid on it, and we thought we bid pretty well, and someone came along and bid 5% more than we did, and that's fine, because you spend a lot of your time putting in bids for things and not getting them. But so it's not that I'm not in the market. I'm always in the market. I've always been in the market, in bull markets and bear markets, where there's an opportunity, and that's what we do for a living. Isn't that what people do for an opportunity, for a living? Most things, where there's an opportunity, you go and find it. In our case, it tends to be big, lumpy, old, expensive pieces of real estate. But so I'm not. I don't want you to kind of. I'd hate to people to go away going, he's really negative. I'm hopeful. I hope that, and people who have access to capital may well do okay, but it will be because the economy is doing badly, and because opportunities occur because of dysfunction, whether it's private credit markets or, I do not think values are going up. I really don't. Someone will turn around and say, well, they did in that area, or yes, but I'm being generic.
Generalistic, yeah.
And it's the biggest asset class on the planet, so it's difficult. Shouldn't really be generic about anything in real estate, but I'm not here to talk about Northampton light industrial, so it's generic.
Has your definition of success over the years changed?
Yeah, because when I was young, it was all about financial success, and actually some of the most financially successful people I know are the biggest assholes, so you learn that I was very focused on making money, as I said right at the beginning. It was like, that was what was going to fill my void. And then when you make it, you worry about keeping it, or I do. And then you start meeting other people who felt the same way as you do, but you're very introspective while you're doing that thing. And then there's a stage, a sort of interim thing, where it's about points on the board. It's like playing cricket. It's like, how many runs are you scoring? Not, can I afford my gas bill? No, I can afford that. It's how am I doing against my peer group? And then you actually realize that success, and I think this comes with the years, is about the person. Are they a good person? Are they a humble person? Are they honest? Do they have integrity? Doesn't mean they can't be very hard. Some of the best businessmen I know are very tough, but they are also totally, once you shake hands, Philip Green gets a terrible rap. I bought real estate when Philip bought the Sears Group, and he sold us a bunch of real estate. He was absolutely 100% down the line. The deal was the deal. He shook hands, did the deal. So in business, I can't ever say anything bad about him because I've only seen good in him. In terms of, he was hard to deal with, sort of tough in terms of negotiating the deal. But once it was there, it was. And I like people like that. I like people who you can shake hands with. They can be very hard and bloody doing the deal, but once you've done it, that's it. They are not going to deviate from it. There are plenty of people in this world that I have done deals with where you shake hands and they sell you the earth. They're going to do the deal, especially on the selling side. They're going to do the deal. They're completely legit, and they would never let anyone down. And then they screw you around. Well, they only ever do it once to me. But, and so I like people who, in business, if you were talking about business success, who are straight, who are honest, who have integrity, who do the deals that they say they're going to do. There are so many messes. There are so many messes.
How do you stay so grounded, given the success you've had and the yachts and the private jets and the other bits and pieces?
It's very nice you say.
And I think people listening to this will be, because throughout this whole conversation, there's more than just a weave of humility all the way through. And, clearly, as you touched on, there's a little bit of paranoia and the kind of the bed sit in Cricklewood or wherever it might be. How do you stay so humble and grounded? And, there's many people in your position who no way would they give up a couple of hours to come and talk to me on a podcast about their background and journey.
It's very nice of you to say that, but I don't. I don't know. Maybe my wife, probably, because I'm the boss till I walk in the front door of the house. My kids, who I'm not the boss. I don't know. It's very. I've just been blessed. I've been very fortunate. And I guess I learned some important lessons early on, not because, I think because I came also from a pretty humble background. My dad had a little jewelry shop. Literally, it was such a small shop, didn't even have a toilet. He used the toilet across in the public toilets in Kilburn High Road. And, I grew up in different surroundings, even though I went to private schools. I was always quite comfortable around people who, working class people. And even though I had a posher accent than they did, and they would make fun of me, I don't know. Maybe it was that early stage in my life where I recognized that people work very hard. A lot of people work very hard. I used to help the milkman do the milk round, and then he used to get up at 5 o'clock every morning, and it was a horrible job, especially in those days, and I would help him on Saturdays and Sundays. Actually, the most exciting thing was driving the milk float. He let me, if you can believe this, at the age of 11, he let me drive the milk float around the little streets in Cricklewood where we lived and deliver But I became very acutely aware that working class people, that I certainly was around, certainly low middle class people. I hate pigeonholing people, but I saw how hard they work just to pay rent, to put clothes on the kids' backs, and to put, and their enjoyment, their fun was, I don't know, going to the pub or going to maybe see the local football team play. That was it. Their holidays were maybe a week at Butlins for the year. As a kid, I went to Butlins. My dad took my brothers and I to Butlins. And so you mix with a bunch of people, and maybe that makes you more human, because if you're very privileged and grow up surrounded by wealthy people like you, I don't mean like you, I mean like one, maybe you don't get such an important perspective. It's always been important for me with my kids, even though, of course, they grow up in amazingly privileged lives with boats and planes and, but we have been on several charity projects where we take them. One we did in Malawi for 5 weeks and build schools and literally physically do the thing. And you meet people. And then we did another one in Peru, in the Andes, in a really remote spot, working in orphanages there. And we just wanted, Maxie and I just wanted our kids to at least see how some people have to survive, literally just to survive. It doesn't, and then you come back into your privileged world, but at least you've got that in your head, and you've got, oh my God, I've seen how in Africa these people live hand to mouth. The kids have to go into the field to catch mice, which they split open with their fingernails and then put them on sticks and cook them. Actually, I learned something amazing on one of the trips. Actually, it was in Malawi, and when we weren't working, we would go with the kids into the fields, and there would be these holes, and they had and there would be hundreds of these kids surrounding us, and they would go and they would catch these mice and kind of, cut open. They all had a small fingernail that they kept long, cut open the mice, take out the insides, the intestines, and then put them on a stick, and then they would light a little fire and they would cook them. And one of the amazing lessons that stuck with the boys is when they were cooked, it didn't matter who had caught the mice or how many kids there were. They shared a bit of the mouse meat with each one of the kids, which was extraordinary, because for me, it exemplified what's so wrong with us. It's like we take and we keep and we hold on to, and for them, this is food. This is food that they eat. That's a luxury for them to have, and they were sharing it, irrespective of who the kids were. And I thought that was incredible. And we talk about it with the boys sometimes. It's like that. What does that teach us about where we've come as a society? And I think till quite recently, pre-industrial revolution, people were living in villages and they looked after each other and they cared for each other, and they, I'm sure there's lots of bad stuff going on, but we seem to have lost that sense of it's all about me. It's all about what can I do? It's all about what are my benefits? What is society doing for me? Why am I not getting more from the state? It's literally gone completely the wrong way. And the cost of that is that we can't afford it. The cost of that is when it goes back to the societal thing again. And we're allowing ourselves now to be infiltrated by bad forces, and I don't know where it ends up, but it's not, I don't want to end on a...
No, don't. Well, if you did lose it all today, or someone listening to this, do you think someone will be able to replicate the financial success you've had during your kind of 40-year career in today's market?
No, I don't, because I think, first of all, the capital sizes of deals are so much bigger, and I mean even inflation adjusted. My first ever deal at the Allsops auction was £5,000, and it was for a building in Northenden Road in Sale in Manchester, a big building that was a house that was let on on a regulated tenancy. It was a protected tenancy. 5,000, and even if you inflated that at 25,000, there's no property at 25,000 today. If you go to auction, you might buy something for 200 grand, but you still need to get hold of that money, and you still need big deposits, and banks won't lend you if you come off the street. Whereas in those days, they kind of would consider it, and if you gave them a bit of collateral somewhere else, and the local bank manager had the authority to do that. That's not happening today. That's number one. Number two, in my career, because quite a lot of what I've done has been non-property. Things like, intellectual property rights and private equity investing. And I think the chances of you doing both of those today are, no, it's never going to happen. And I think in PLC terms, the enormity is what I said before about the auction at 5,000 going to 25. Well, the enormity of PLC is you've now got to really work your way up through a corporation or some company. Most of the big companies, the big REITs, are run by accountants today. They're not even run by property people. I think it's really, really difficult. I think if you're super smart, and to be super smart at KKR, Starwood, and now I'm talking about Blackstone, it's not okay to be come top of your class and be summa cum magna, you've got summa cum laude, you've got to be now magna cum laude. You've got to be like, to get in to the front door. They don't take, they have these, John Gray explained to me how they sift through the thousands of applications they have, the algorithms they have that sift through. And he knows that they're getting the most talented academically, the ones that have done the Duke of Edinburgh Awards or travelled around the world and saved the planet or done whatever. That's the 1,000 they end up with to interview. It's still 1,000 they have to interview. And all the rest are coming through. And he goes, I know we're missing entrepreneurial, really talented people. He goes, well, I have no way of interviewing 10,000 people. We can't do that. And I've got no way of knowing that the people interviewing them would spot the entrepreneur anyhow. So you end up sort of slightly Stepford wiving, becoming sort of more and more assimilated and the same as you go up the organisation. And it takes years to do that. And to get in the first place, you've got to be really super smart. So I think the days of real estate have just changed so much. But fundamentally, it's still a great career. Agency is going to change now with AI. Everything, professional services are going to change with AI. So I still think you have to be really, really good. But if not, you need to attach yourself to someone who is entrepreneurial, who has access to capital, who's done that hard yards, and make yourself invaluable to them so that you can slowly get equity. And that's that is the same today as it was then. Find the person, prove earn your spurs, make yourself invaluable, and then you get equity, and then you can ride that. But so in that sense, it hasn't changed. But in the sense of what I did with public companies and private companies, and I think that's changed. I think the chance of being a quoted company CEO at 25 or 26 and having that career growth that I was lucky enough. I would never say never, because it will happen. The markets do work in cycles. This is going to be a very long cycle where someone will come along and invent the next something. But I didn't invent anything. I just got market timings okay. So it's tricky. I think it's tricky, but I do think it's a great career. Just you're coming at it from different places now. And so I qualified as a chartered surveyor, and I'm glad I did. And I don't think you're going anywhere really fast unless you are a chartered surveyor if you want to be in professional services today. But you can be entrepreneurial without any qualification at all. But you've got to find someone who's going to let you in the first place to prove that you're that person.
You've spoken about Labour government next 4 years or what have you. What happens kind of post-Labour government? AI, tech, revolution, things kind of settle down. Some of that filters through. What's your take? And what do you think will happen after that?
So I think you go one of two ways. I think we're going to be even more polarised societally than we are today. Economically, I think it can only get better. I'd like to think it can only get better, because I think people will be so fed up with has to be austerity. Yeah, I mean, you can't keep putting up taxes on ever shrinking tax base. There's going to have to be austerity, and there's going to have to be, in a major way, cuts to the welfare state, the NHS. You can't have the entire GDP as debt. I mean, it's a problem. So I think for real estate, I think that there are, and business generally, I think the end of this Labour government could be positive. They say 6 weeks is a long time in politics. 4 years or 3.5 years is a very long time in politics. We'll have to see what happens, but I just think people will be repelled by anti-capitalism, because they will be recognising, because things will be pretty tough, they'll be recognising that capitalism is absolutely vital. We need to create wealth. If you don't create wealth in society, you can't afford society. And that's not just AI, it's like nuts and bolts, and real estate included. So, I think there's some positive things, but we're going to have to sit tight and
Yeah, the challenge will be getting people like you to come back to the UK, having kind of relocated to Portugal, Italy, Spain, Dubai, wherever it is, to upheave their life and their kids and their families and their friends to come back.
Funny enough, I don't. The nature of communications today is you don't need to be in the UK to be in UK real estate. I'm doing what I'm doing, and I'm backing people in the UK. Just because I'm sitting in my office in Monaco doesn't mean I'm not doing that. It's more, is the UK attractive to invest in? It's not like I'm investing in, Sweden and not the UK because I'm closer to Sweden or in France. I want to invest in the UK, and I am investing in the UK. I've done a few deals in the last 12 to 18 months. I would, and if there's an opportunity, I'll do it tomorrow, despite everything I've said. So it's not that being in Monaco physically is difficult because I'm backing people here. It's more about the state of the economy, the trajectory of the economy as to whether I'm going to do it or not. And by the way, I'm an hour and a half away on a plane to pretty well anywhere anywhere south of Luton anyhow. And so I can come back and see and look and sniff around and have a look at the deals that are there, which is kind of, if I suppose an hour and a half is what some of my staff used to commute.
From the home counties.
So it's really not a big deal, that geography thing at all. I get lots of sun, which is nice. So it's more about the opportunity, and we have got, look, on the positive side, London historically has been one of the most liquid real estate investment markets on the planet, and even though we have more liquidity today for reasons we all understand, it will always be, because of the rule of law and democracy, the way democracy works here, Parliament, the parliamentary rule of law, it is always going to be a place where people will consider putting their money if the economic omens are correct, are good. So long as we maintain that and we don't allow ourselves to have that threatened here in the UK, there is always going to be a market here, which is good news. It is, but there's no guarantees that parliamentary democracy is going to be maintained. Some of the more successful economies in the world now are benign dictatorships. UAE, Singapore, Indonesia. They may not tick everyone's boxes, but they're doing bloody well. They are doing very well. And so who knows what happens to parliamentary democracy? But it is a unique feature of the market here. So I'm let's make sure that's maintained. And let's make sure Britain stays a proper Western civilized country with parliamentary democracy, because without that, we're screwed. We really are screwed.
So Nick, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to allocate that capital?
It's going to sound really boring when I say this. I'd give it to Andrew Jones and the team at London Metric today, because I consider a 9 to 10% compound annual, conservative annual growth in today's environment a very, very satisfactory return. It features very low on the risk curve. I think it would be difficult for me to go and say there's any other sector or that I would look at and say go run with the 500 million. I just don't feel it. In my bones, I'm not really feeling that. Whereas ultimately, business about management, and management will make you a fortune, lose a fortune. But I think that their formula, I know it sounds terribly like I'm selling the book here, but I'm really too old to bother about selling the book. They're doing well enough without me selling it or not. But genuinely, as I said before you asked me that question, if you can produce 50 million quid a year out of your 500, year in, year out, you're not going to shoot the lights out, but you're going to retire very wealthy. So that's what I would do. And if you really want to be a bit more ballsy and put a little bit of leverage in there, just a little bit of leverage, and then your 9.5, 10 could become 11 or 12. And although it depends what your investment criteria are. So that's where I would be in this kind of mix of. Interestingly, London Metric doesn't have a single office building in their portfolio, not a single building. That doesn't mean they won't in the future, but offices are in a state of flux. So I can't put my money into offices because I don't know the price. There's no price transparency. I don't know if I'm buying something at 6%, whether that's going to be worth 5.5 or 8 in 12 months' time or 18 months' time. And that's one of the great issues. I think in logistics, for reasons we talked about, I think there's much more safety. I think what's happened is the growth that was like this in logistics rates is sort of now more like this. But I can't think of too many other sectors where it is like that. So anyhow, I would trust him to invest my 500.
And if I give you a little bit more, you touched on kind of backing others.
Yeah.
Who kind of, from the people that you back, who are those people and the property and the places that they invest in then?
I don't really want to name them because I think that's slightly unfair, and I don't want other people to go to them and back them instead of me and offer them cheaper money. No, that's not really the reason at all. But Ben Walford is a young man who joined us 20 years ago at Prestbury, and I've worked with him and seen with him, and so he invests money. This is about opportunistic investing. I have never, ever been a portfolio investor. I don't have I've always been about the deal. And I often used to say to our investors in the early days of the PLC world that I inhabited, if you ever hear me say that we're light in East Midlands industrial, sell our shares, because it means I've gone from being entrepreneurial and opportunistic to becoming portfolio manager. And it's not me. And it's very interesting actually, because in my personal life, having sort of semi-retired, I have now had to transition from being entrepreneurial, whatever that, business, commercial,
wealth creation,
creating wealth and about trying to make money, to wealth preservation. And those are completely different skill sets. And I am absolutely out of my comfort zone in doing it, because all the things I said I was never going to do, not having too much money in equity, in bonds, in gilts, in this, in that, I'm now having to practice. And then I don't really know people in this world because I don't inhabit that world. So wealth managers, and it's a new breed of people to me. And I'm like, holy crap,
am I getting sold? What does this mean?
Yeah. And I'm spending a lot of time and energy in trying to dissect. And the more I look, the less I know, and the more confused I get. Because, this fund manager's shot the lights out. Well, actually shot the lights out in 3 out of 5. So if I'd come in 2 years ago, I'd have done my brains. If I'd come in 5 years ago, and you have to dissect all this stuff. And I find it very dull and I don't like it. Whereas I'm much more used to investing, finding a deal, getting excited, working it, buying it for X, selling it for Y, investing again, and starting. So I'm now doing that vicariously through these young people, and it's the opportunity that excites me, not the sector. I honestly am agnostic about sectors. So even office buildings, I would look at office buildings, but they would have to be patently cheap for me to get excited about them. And things that are attractive are, generally speaking, not opportunistic. And they're going to have lots of people wanting to invest their money in. There's an incredible cutoff point. If it's in the sweet spot, you're going to have lots of competition with lots of capital chasing it. If it's outside the sweet spot, it's going to be cheap. How cheap, you don't know, because it's not in that sweet spot. And then you kind of go, oh my God, what's the future of this one? And funnily enough, I said to someone last night, we were having a sort of similar conversation, and I said, the hardest thing to do is to buy in the worst markets, because you need the biggest cojones. It's very easy to buy in a bull market because everything's going up, but in a bad market, because everyone's terrified things are going down. So spotting the opportunity in the bear market is the challenge that anyone who's listening or watching this, who does have access to capital, it's like, when do I go? Because, I've always taken the view, I'll miss the first 5% or 10% because I won't be the one right at the bottom. But on the other hand, I'm probably going to be better off then I could lose 20% if I go wrong. So I am probably a bit of a follower, and I know people go, "Oh no, you are good at forecasting what happens in markets." I'm not really that good. I just apply common sense, and many people are very much more analytical about what's happening, whereas I'm a little bit more intuitive because I can't add up, so I can't do analytics.
Well, it's definitely stood you in very good stead over the last 40 years or so, and you've done incredibly well from it. And when I get that kind of real, rather than a hypothetical 500 million quid, I'll give you a call to see if you want to kind of back me before I back other people with that capital.
When you get that 500 million pounds, I will be very happy to sit as a non-exec, just to make sure that you don't spend it badly.
Well, Nick, I mean, out of everyone I've had on the podcast, I've had over 150 people. You're probably best placed to be able to do that. So I would absolutely love to
tell you what not to do.
Take you up on that offer. Nick, I think this is probably the longest podcast conversation I've actually recorded in over 150 that I've done.
That's how much I talk.
No, well, that's the idea. And I feel like we could talk for an awful lot longer. You've been incredibly generous with your thoughts, insights, reflections, honesty, and views. And I've really enjoyed this conversation. And genuinely feel really, really privileged and honoured that you've kind of made time in your very busy schedule to come and talk to me. So
it's genuinely a pleasure. And I hope, I don't really know the profile of the people who watch this and listen. I hope someone somewhere gets a spark out of something, because the greatest gift is actually giving. And that applies to many, many facets of life. And actually, if you can give back a bit, even if it's only a little something to one person, it's kind of worth doing. And the truth is, I'm not quite as busy as I used to be, thank goodness. So, but nonetheless, it's an absolute pleasure doing this. And thank you for having me.
Thanks, Nick.